Hello, hello, hello. Good evening or good afternoon and good morning to those in America or other countries. Nevertheless, we're here. It's currently 3:30ish in GMT. To be exact, it's 3:36. I was doing some of the revisions of stream. I think last episode I was kind of listening to it more than making any notes, which is good in the sense that I don't want to clutter my note takings as much, but I did literally listen up to episode 24 and I didn't remember much. So we've gone through, starting from the beginning of episode 19, we're now 30 minutes in, Reem taking notes. We are not taking notes as much or in detail as if we didn't know some things because he was essentially showing us things that we shouldn't be trading. And he was making a lot of good points in terms of how to manage yourself psychologically and good money management, etc., etc. So what we took down is that it is possible. Instead of giving an example, we just described it by words that it is possible to trade against the higher time frame bias, but we don't do it. And the reason why we don't do it is because, generally speaking, you will lose money over time. It's very simple. But there are those that can adjust the price and then sell in a bullish bias. But they are more so short term traders. They know what they're doing, they have the experience, they've back tested. So we just avoid it for now until further notice. And this is the daily time frame. And ICT was making a point that there's going to be some traders that, they don't trade. They're not technically day traders because of maybe it's time or whatever reason they may have, right? Maybe they have a job, maybe they're busy, maybe it's this, maybe it's that. So instead of them trading the time frames of the 15-minute to 5 minute in terms of entry, obviously you will regardless have to look at certain larger time frames, but they would avoid time frames that are smaller than maybe say the daily. And you can still use the model, but the difference is in theory, right? Let's say you enter the sell here. Or let's say you enter the sell here, right? And you want it to deliver here. Look at how price gets around this low right here. And it just consolidates. And then finally wicks to take this low out. 1, 2, 3, 4, 5, 6 days of just kind of nothing. And you had 1, 2, 3, 4 days. That's 10 days, a 10-day trade almost, right? And it's like all of that for 1 to 2 or 1 to 3 or 1 to 4. It's like depending on how much you're risking. If you had £1,000, you're risking 10% even. You're waiting 2 weeks to make £400. Is that worth it? To some it may, if you're using it as side hustle. But you're also going to lose sometimes. So that's why I'm not really a fan of the long kind of swing trading unless you or position trading where you really know you have capital and understand the markets at that level. Then we went into zooming in. So this is a what not to do. And this is a different chart. I did have an hourly view of this, which I low-key should probably include. Let's actually include in the previous slide. Grab this. Let's put it here. There we go. Bosh. Just get rid of some of the noise. So this is it. And essentially from this swing low to this swing high, we have a range. In that range, we have this midpoint roughly where price comes down to it. We feel this kind of gap over here, but we also come to the equilibrium. And one thing we actually talk about is that this is the daily low. So this blue line here. Is it blue? It's blue. Yeah, it's blue. It looks black because it's so thin. We have this blue line, which is this, I believe, daily low right here. Should be able to zoom in too fast, not really. Wait.
Now, Purge and Revert, you can do a YouTube search on that. It's in my YouTube channel. It's a teaching that I'm going to allow you to go back and look at. Looking for the daily delivery on that candle. Judas swing, buy below the opening price, expect displacement to the upside, run into liquidity, offset, sell to buyers, move to the sidelines, you're done. Now, what does that look like on a lower time frame?
I was meant to take 15, the hourly, sorry, not the daily. That's what was causing the confusion. Cross. Mm-hmm. Okay, that's done. So that gives context to this. So we have this daily low that we swept over here. And that's essentially saying the price is being oversold, right? I'm talking RSI language, relative strength. I think it's relative strength index that means. And I'm not talking about that because that's just noise. That's just nonsense in my opinion. But the idea about this being oversold, that terminology I'm using, is essentially just describing the sell stops being taken out, the sell side liquidity being taken out. Because after that happens, then you're normally in a discount, which showcases overselling, but also that means that the reaction to that would then be that price delivers to a higher level or a higher price. The market's moved price to a higher value because of the fact that you've just taken out liquidity on the sell side. You're now going to hunt for liquidity on the buy side, which looks like a reversal. That's where you get this idea for buying from, and that lines up with that. To be fair, that range is not bad, but this. So you see this blue line here, that's the daily low right here. We can see we take out sell side from this low, which once we zoom into the hourly, we then have this. So it kind of does go hand in hand. But yeah, we have this daily low. And when we have it, price sweeps it. We then push up, break, retest, and we have this over here.
Here's the 15-minute time frame. Here is the relative equal highs, buy side liquidity resting there. Look at this price action here. What do you see? Pause the video. This is that moment where you want to study and look at.
I'm so hard. Let's look at that.
Got it.
Price action. Okay, well, we have taken our buy side liquidity. So give me a second. I need to take off my hoodie.
Okay, I'm going to continue now. All right, so here we have this low. Why am I picking that low? Why not that low, Michael? Why didn't you pick this low, Michael? This here is a range that we worked in. I mentioned this was brutal when I was discussing it with my students on Monday in its commentary. But this movement here, this is the most recent swing low. It rallied up and it created a higher high right above these relative equal highs. So there, at point 1 to point.
Sorry, I forgot about what I was doing here. Okay.
Here. What do you see?
So looking at price action. Well, we'll start from here. We can see we're dropping. Create equal highs over here. Price keeps this. That's not displacement. But never knew is that actually. Swing at or put some high over here. Okay, we have an imbalance over here, which price comes back up to. There's one here as well. It's voided. Be an order block over here. This is an intermediate term high. With equal highs with this. Sweep this liquidity. After we come back up here, we don't take out this intermediate term high. We just create equal highs over here. That's buy side liquidity. Price from that down to this. Lower here. Takes it out. Imbalance. Belly up here. I'm not really seeing anything
Pause the
clean.
video. This is that moment where you want to study and look at it. Okay, I'm going to continue now. All right, so here we have this low. Why am I picking that low? Why not that low, Michael? Why didn't you pick this low, Michael? This here is a range that we worked in. I mentioned this was brutal when I was discussing it with my students on Monday in its commentary. But this movement here, this is the most recent swing low. It rallied up and it created a higher high right above these relative equal highs. So there, at point 1 to point 2, that's your dealing range. Okay, I'm using that because it's the most energetic, most recent low and high. This is where I think the market's going to go up to, because I think all of this movement down here basically is accumulated all the sell stops. So now smart money's heavily net long, and they are sitting on all these, counterparty traders that either were knocked out of the marketplace and they absorbed all of their sell stops, or they're caught offside and retail's trying to go lower. It doesn't make a difference. I'm not suggesting that you should even waste any time trying to figure out what that is. I'm just saying that below old lows is sell stops, below old highs is buy stops. Just have it in mind. It's just that simple. Now, knowing that by itself is not enough. You need to know what is likely to occur. Here is the midnight candle in New York. Okay. How do you know that? Over here on TradingView, click this little area down here. It'll pop up a list of time zones and such. Scroll to New York. Always put your TradingView chart on New York. I don't care where you live. You do that. Everything I'm teaching you will line up. Midnight opening price. The opening price is here. Draw that out in time. And that's your New York midnight opening price. This is the price I want to preferably be buying below. Now, there are instances where the opening price will be lower, and then the market is trading higher, but doesn't go back below the midnight opening price. This is why I said 8:30 opening price. 8:30 is when a news embargo lifts, and a lot of news comes in around 8:30 typically. And I use that opening price there. Now, in this instance, this is why I'm teaching it to both groups today, because this is kind of like just a dandy of a setup. It means it's really good. I like these types of setups I'm going to show you here. When it delivers something like this, it's almost like it's presenting it to you on a silver platter. Like if you really, really want a good little setup that's going to just be a real nice crackerjack, it just delivers nicely, it's this one here, okay? If we're bullish, okay, and I'm assuming that you'll trust me when I show you the video clip from my private mentorship group, folks that are in my private mentorship group, if I'm sharing something that was edited, if I've changed that video in any way to make it seem or sound like something that really didn't take place on Monday at the 13-minute mark of that video, please say so in the comment section, okay? You're welcome to roast me, okay? I'm only telling you that because the comment section is open on my videos. You guys can say whatever you want to say. I don't care. Bottom line is proven it. Okay, I'm proving it. That way you can feel comfortable learning from me. There's no sales pitch here anymore. Just put down all your reservations and just grab a pen and pad and listen. And I promise you, what you're looking for, it'll come. The confusion you're getting about the opening prices at midnight and the opening prices at New York, 8:30 a.m. Last ditch for Power 3 is 8:30. What does that mean? If the opening price at midnight, if you're bullish, is lower than prices trading at around 8:30 or after 8:30, then it's likely it's not going to be a factor. Then you use 8:30. If there is a day like this one here, where we have the opening price at midnight here, we're already below it. And after 8:30, we're below it again, still below the midnight candle's opening price. We're really at a discount. Like, we're really, really cheap on the day when we're bullish. Now, think about what I've outlined so far. It seems like a long way here, but everything I've discussed is paramount and crucial for you to understand why this is occurring, because these are the things that are going to repeat. Don't take my word for it. Start backtesting and logging your charts like this, and you will see these events repeating because it's algorithmic. It will not do it every single day, but every day it will be present in something. That's why I say with my motto, it's every week, every day, and it won't stop. It does not mean every week, every day, and it won't stop every single individual market, because you have to be able to navigate. Some days it may not happen in the futures. It might be in Forex, or it might be in bonds. So you have to be flexible in that regard. Okay, but every single week there's this type of setup. Every single week there's a setup like this. Inside this range, it moved from here to here, and then started retracing down after midnight. Notice that? So all of this here is a Judah swing. Judah swing is the move that's opposite to what you expect the daily range to be. So if we're bullish and we think it's going up here, we like this movement going down. We love it. Now, you may not feel comfortable buying the London or overnight lows. That's fine. You don't need to. Wait for 8:30. If we drop below 8:30's opening price, and here's the kicker, we're below the opening price at midnight too, we are really, really oversold. Does it take indicators to see that? No. Did you require some kind of divergence? Nope. How about Fibonacci? Nope. Easy, isn't it? Visually see what's being shown here. Below the opening price, you want to be a buyer at midnight. By itself, that's always the basis of what I'm trying to do each day. Then, if we get an 8:30 candle that opens below the midnight candle, and then we have a movement below that, that move here also is like a micro Judah swing for the session of New York. This is a Judah swing on the daily range or the daily candle. So this is basically building the low of the daily candle. This is building the low of the New York session. Both are using the Power 3 concept, which is accumulation, manipulation, distribution. So what we're saying is this movement below the opening price at 8:30 and below the opening price at midnight, each move lower is the trap. It's the snare that catches traders thinking it's going down. We are looking for that move. We're looking for that drop down, not just any old indiscriminate drop in price. We're looking for a very specific thing. Now I'm down into a 5-minute chart. Same things I had on a 15-minute time frame, I now have just showing and representing it on a 5-minute chart. I want you to take a look at price, study, think about what you see in price action here. Pause the video,
Okay, so looking for some price action here. So with the power of 3, we're expecting manipulation and accumulation, distribution, or expansion distribution being the third kind of move. So because we're bullish, the power 3 is going to be the opposite of bearish. So from the midnight open, we get that you'd assume that manipulation, which will be basically in GMT terms, 12 to 8:30, which is 5 a.m. or technically now it's 4-hour gap, so it'll be 4 a.m. to 12:30 in the morning. So 1:30 p.m. GMT would be where we start looking for the moves. But we have the New York open, midnight open. Then we have the New York session open over here. It's a midnight session. You can see here, this is bam, 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 bam. We're bearish here. We also have an imbalance here. We come up to it here. Have a reaction to it. This is why we don't trade against the trend or the bias, because in theory, this is a sell signal. If the market shot the shift, the fair value gap, we then come back up into it and then we sell to the downside, but only up until here. And it actually comes up down to this fair value gap over here. And you can see we're bearish. Bam, 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 bam. We meet this fair value gap. We then push up, break the previous high, bam, break this high, pull back into the range, and then we expand upwards.
If you're not ready, I'm about to begin. Right there. See that fair value gap right there? See these two unclosed candles? See that? That's your order block. That's bullish. Your fair value gap. At 8:30, we have a drop down. At 8:30, we're looking to the left and see where are our short-term swing lows, because we want to absorb sell stops, because smart money will pair that with their buys. And we're looking for an imbalance, preferably. And we just happen to have it also with an order block. So a lot of things happening here. It comes down, hits it, and then rallies. 8:30, opening price. We find it come back down into it, find some support, and it springs aggressively above these short-term highs. By itself, that right there is enough. That's a beautiful run on S&P, and that would be enough. You don't need to have the objective up here. But if you're holding it for the daily range, you're going to wait for it to reach up in here, and it does so here. Now, in this area, if you notice what happens, it rallies up and consolidates during lunch. And around the 2 o'clock hour, going to the 3 o'clock, we run back down into sell stops. Traders that have trailed their stop loss up because they don't want to lose any of their profits. And then they pump it one more time up into the PM session or afternoon move into liquidity that was outlined relative equal highs on that 15-minute time frame. Here is the 1-minute chart. How can you apply what I've been teaching you on the YouTube model? Well, here it is. Here is the low forming. And now find the setup that would occur with the YouTube model. So in other words, we're seeing a movement here. The bias is bullish. We're looking for a continuation on the upside. We have a target based on that 15-minute time frame, relative equal highs. What does the model I'm teaching on YouTube, where does that exist here?
Okay, cool. So looking for the model. Okay, so from the minute or the session open, we push the downside. We have a market structure shift right here, because we not only take out the previous high of the kind of downtrend here, or this short-term high, bam, 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 lower, lower, higher. That's the swing high over here, short-term swing high. Excuse me. We then have price break the high, but it breaks it with a fair value gap. That's what makes the market structure shift valid. It has to be an impulse, a sudden movement. So break the high over here, right? And then in that displacement range, which will be from here to here, we look for a fair value gap, and we see one right here. Price comes back into it. You can see like right here. And then we buy and expand. So that will be our first entry. We technically, let me see. This will also be the order block here. Bullish order block. Lines up with the fair value gap pretty much. we have another entry here. We see there's an imbalance here. We take out this high over here. We trade above it. We then come back down into this fair value gap, which if we put our stop loss below this short term low, bam, bam, bam. You see this is extreme. The price will be fine. Bam. We can enter another buy here. So that's two. That's only two I see.
Again, pause the video. Use this moment to really look for it yourself. If you just wait for me to show it to you, you waste the opportunity on learning. All right? Don't be upset if you don't get it. It's okay, but I'm going to show you now what you should be seeing. Okay, the market has a run above this short-term high. So we have a shift in market structure that's bullish. What's this? Fair value gap. It trades down into it, hammers it. 3 consecutive down close candles. That's what? Your order block. All consecutive, because we're looking at 1 minute candles. That is the order block with the fair value gap. Buy it there. And then comes back down, retests, sends it higher. And then one more time, New York midnight candle opening price. Opportunity again. Trades up into the New York midnight opening candle. Trades back into another gap. Trades into the midpoint of that.
I missed this. So he didn't need for the compound. He wasn't looking for a break of a high. I was looking for a break of a high over here. Hence why I saw this entry, but not this entry, because we have a gap here. Wait, he said, what time was it? Midnight. How does that make sense?
Opportunity and buy it there. Candles. That's what? Your order block. All consecutive, because we're looking at 1 minute candles. That is the order block with a fair value gap. Buy it there. And then comes back down, retests, sends it higher. And then one more time, New York midnight candle opening price.
Okay.
Opportunity again. Trades up into the New York midnight opening candle. Trades back into another gap. Trades into the midpoint of that. Rallies up. Consolidates, and then expands up into our objective that was outlined in that 15-minute time frame, the relative equal highs. Now let's dig a little bit deeper.
I was literally about to say this. Because of the fact that when we have the daily time frame and we have, I believe I have an example of it. Wait, what is this? Okay, we can use this anyway. What? So, we're bearish from the open, midnight open. We're bearish on the aspect of the power 3. That is the first part. So taking this most far right candle right here. This is a bullish candle because we open here, we close here. So we open low, close high. That's an increase. That's a buy. That's a bullish, right? So when it's bullish, normally what happens is that price goes down first, right? So that downward movement is the manipulation. What do we have here? The midnight open, because of it's the daily candlestick. So this is from midnight. Okay, that's daily from the midnight. So this is midnight. We have that downward push, which lines up with this first initial move. Then we zoom in and we look at what makes price go up. Well, we have an accumulation of buys in this instance. So from here to here, map that forward from here to here. So that range from here to here is where we can look for opportunities. So from this move downwards, we're already looking for where do we move. Obviously, we only enter between the kill zone, which is 8:30 to 12 or like 11ish, right? So between here and here is where we're looking for opportunities. But we're also looking at it in terms of price and time. So when we're drawing out this midnight open across, you can see here that despite, oopsie, I don't really have it exactly here, but this is around 11:12. We had the first entry over here. And then over here, we have the second entry because of the fact that we are within that, we're right next to this. So we've come down, we've come back up, back to this same level. But guess what? Because we have a bullish bias, we're expecting this to happen. We don't know how far it's going to go, but we're expecting this to happen. And in terms of price, you can see that the high and the low at the close of the day is close to each other, meaning that the peak of our buy would happen at the end of the day-ish, roughly, because of the fact of the power 3. Not always going to be the case. So you can see here, we opened here, went up, went all the way down here. This is the low of the day. We closed here. So if I was going to sell here and I targeting lows down here, the close of the day, I would probably break around even. be around break even because of the fact that open and close is close to each other. So not every day is going to be perfect, but you can see more often than not, we get that open manipulation, accumulation, distribution, and the low is close to the close, right? So that's how we take that as our kind of sign, especially when we are confident with the bias. This is a day where, though it was bearish, it's basically break even, and you can see it's the indecision between selling or distributing lower and distributing higher. So that is a specific case. Over here, we can see from the open and the low, right? This is being the low with hindsight, this being open in terms of the power 3. We can then keep entering from here to here, from here to here. So from here to here, maps upwards. We can potentially be looking for entries from here and here, depending on time. Obviously, if it's up here and or the time is like close to the low, the close, we won't enter. So we have a time frame where we expect the accumulation to happen. So that's why we don't always enter here, because the kill zone is here. But if we were to be up here at this time, so let's say instead of it being here, it was over here, we could potentially look for entries as long as it satisfies the model. So New York midnight open, price comes back up to it. This is the previous low. And then, yeah, that's what makes us enter. Now, I need to take a little break just so I can type everything up because it's going too quickly. So starting off with the idea. So we have a bias, that's our bullish bias. We have midnight open. Signifying the open of the day, which is literally self-explanatory. So let's get rid of that. We have midnight open. Starting the power of 3. Price rally down in aligning with bullish bias manipulation to the swing. Model. Wait. The model for the entry is we take. The only thing is that we didn't really take sell side like that. To be fair, it's just like another model. I forgot the target. What is it? Oh, I think it's this high over here. So I'm gonna say daily high. Yeah, so that's that done. Then this is the same thing. I might withdraw it back a bit so we can get the annotations of the fair value gap.
Here is the 1 minute chart.
This is the 1 minute
How can
chart.
you apply what I've been teaching you on the YouTube?
Yeah, he's about
here it is. Here is the low forming. And now find the setup that would occur with the YouTube model. So in other words, we're seeing a movement here. The bias is bullish. We're looking for a continuation on the upside. We have a target. It's okay. Turn high. So we have a shift in market structure that's bullish. What's this? Fair value gap. It trades down into it, hammers it. 3 consecutive down close candles. That's what? Your order block. All consecutive, because we're looking at 1 minute candles. That is the order block with the fair value gap. Buy it there. And then comes back down, retests, sends it higher. And then one more time, New York midnight candle opening price. Opportunity again. Trades up into the New York midnight opening candle. Trades back into another gap trades into the midpoint of that, rallies up, consolidates, and then expands up into our objective that was outlined in that 15 minute.
All right. I'm not sure what that even stands for.
Minute time frame, the relative equal highs. Now let's dig a little bit deeper. Notice the price low here. It's around, what is that, 43.70 something, 76 or something like that. Well, just for the sake of clarity, we'll just say 43.77, okay? 43.77 is around here on this day. Now, what I've shown is the daily chart, but on an open, high, low, close bar, not a candlestick, because I want you to graphically see what's occurring here. Now, this opening price is not the midnight candle opening price, because you see it's about, what is it, 44.04 and a half or something like that. That would be just above where this opening price is. So my opening price is just a little bit above this opening price. So I'm not using the opening price on the daily chart on TradingView. You can, there's nothing really inherently wrong about that, but I don't personally do that. So that way, for clarity and continuity, I don't use the opening price on the daily candle. I physically go into my chart and use the opening price at midnight. Once that candle begins trading at midnight, that's your opening candle price for midnight. And same thing for 8:30. As soon as 8:30 starts, that opening price on the candle, that's my opening price at 8:30. So I have to wait till 8:30 to candle, or 8:30 exactly at the time, right when it happens, that's my opening price. I'm not referring to any opening or closing price on the candle. Okay, what I'm forecasting with my analysis concepts and teaching my students is I'm teaching them to anticipate these types of moves. So the relative equal highs on that 15-minute time frame is basically this candle's high. Go back and look at your charts and you'll see that's exactly what that is. So this short-term run below this short-term low is taking all the sell stops on that day, on the 18th. The 18th, that evening, I was telling my students that that is when I anticipate that the S&P should go higher and run for those relative equal highs on the 15-minute time frame, because we've already went down into a deep discount on the daily chart, and it's likely to come back up and grab that liquidity. Even if it's just going to keep going lower, that's still okay. It doesn't change anything. Even if it goes higher from here and I'm wrong, it's reversed and makes a longer-term rally higher. I don't care. We're looking for surgical strikes intraday for these markets as index futures. But there has to be some kind of logic. So if we look at what we've done over here and how this fits the daily candle, what I'm suggesting is that my opening price, because at midnight we're a little bit higher, and I don't need to catch that very, very short-term low that's lower than this one, okay? Because that low is right here, and actually a little bit lower than that to the left. I don't need that. This is the reference point at which my methods would see as an entry point. So that's real close. That's like right in here. That's real close to the low of the day. I don't need to have the low of the day. You don't need to have the low of the day. But when you get to the New York session opening at equities 9:30 in the morning, New York time, this run in here, that sets it up. No opportunity here. So we have optimal trade entry here. If you want to trade the OT pattern I teach on the YouTube channel. And then it rallies up. And then you're running all the way up the daily range until we get to that candle's high here, which is the relative equal highs on the 15-minute time frame. Go back into your charts and you'll see that. Okay, this is what backtesting does. It gives you the logic. So what's occurring here is what? It's purging sell stops and reverting back to the high in the last 3 days. Boom. Now, for some of you that need to hear me and what I said in the video clip in my private group, I'll play that for you now. 15-minute time frame, E-mini S&P futures June contract 2022. Again, just
I'm going to go put back on my hoodie. I'm in a vest, so that's why. I'm going to put a shirt on today. But I'm strong with the struggle.
brutal back and forth, just consolidations. And there isn't really a whole lot in here that I like, that they want to reach for, except for just the old relative equal highs. To me, it looks too perfect. It looks too pristine, too classic support and resistance idea. Okay, so a lot of people want to sell short. They want to get short. They want to be bearish on this thing, and that's what's happening with all that. We're getting a run higher. It breaks lower. Then they send it one more time higher, clean up that, drop it once more lower, and now, to me, it looks like they're just going to send this thing vertical to clean that up. If it doesn't do that and it starts to trade lower, I'm not chasing it. I'm not trying to follow suit with that. I just want to give it more time to find out what it wants to do. Because to me, right now, we're so deep in discount on the daily chart, it can come up to this level here and really not upset anything if it's going to continue going lower. That's my point in saying that. All right, so hopefully I've covered a lot of stuff tonight. I talked about a lot of things that students have asked me to touch on in my private group, and I've obviously seen some of the comments referring to the opening price. What is the opening price? What is it? And why should I use it? And how to differentiate the importance between the opening at midnight in New York and that of the 8:30 candle in New York session. So hopefully it's been a little more clear for you. But the main thing is you're looking for an opportunity to anticipate the expansion of that daily candle in one direction or the other, either higher or lower. And in that direction, higher or lower, where's it likely to go? And the easiest thing I teach is old highs and old lows, and relative equal highs and relative equal lows. Those two ways of looking for pools of liquidity are the easiest, most visual representations of targeting there is. It's simple because it's based on sound logic that the algorithm will never be changed because of. Because old highs, right above that, is always going to be buy side liquidity. Buy stops are going to rest above that. And below old lows, there's sell stops resting below that. It's always going to be that way, folks. It always will be that way. Don't send me comments in the videos. Please don't send me emails asking me that question. Do I think by me teaching, is it going to break it? Are they going to change their route? They're not changing anything. They can't change it because that's the way these markets book. That's the way it is, folks. It's the way it is. The sky's blue. Not all the time, but the sky is blue. The grass is green. Not all the time, but the grass is green. You follow what I'm saying? So these are rules we live by. Sometimes there's going to be these outliers, these things that creep in that cause your interpretation of price to be incorrect. And guess what that means? You did something wrong. Does that mean that you're a failed trader? No, it just means you made a mistake. That you're human. I'm human. I'm going to make mistakes. I'm going to read it wrong. I'm going to interpret it wrong. I'm going to react too late. I'm going to react too soon. I'm going to anticipate things that are not likely to occur, and then either I have to take the loss or I reverse. These are all things that you're going to have to be met with in time, and you're going to have to see whether or not this is for you. And some of you, in all honesty, this isn't going to be for you. Not my stuff alone, but trading in general, because it's risky. And don't ever think that something magical is going to happen. If you're not consistently profitable in a demo account and you're not consistently finding setups, executing them, getting in and getting out with confidence on the lowest of leverage. See, that's what I don't like about it. I know some of you are, I don't know how you guys link. I don't know how you guys link in the comments. People link me, but every time I try to link someone, either I'm putting their name in wrong, it never links it, so I never do that. But they'll make videos, and I see it as a mention in YouTube. Sometimes it's a day or two late, so it's not like I'm ignoring you, but for whatever reason, I get these notifications that are days late. And I see folks that are doing videos and are recording themselves actually entering in the trades on the paper trading application on TradingView, which is great. But they're using leverage that everybody knows that they are not really in a position to afford. So I know it feels cool, it feels flashy, and it might feel like you're playing a video game. I don't want you to have that mindset. I want you to think about how you can make this as boring as possible. Because if you make it boring, you won't be a victim of your emotions. It'll be just like you go to work. I'm not saying you love going to your job, but doing those things that you go to work to do yields you what? That paycheck at the end of the week. That's your minimum expectation. You get to work and do what's expected of you. Anything above that, then obviously it's up to your manager to decide whether or not it's warranted to receive anything more than your standard pay. But you need to treat this just like that. It's a business. So when you're doing your executions, don't be influenced by trolls or hecklers in the comment section saying, oh, well, you're doing micro lots, one micro lot. It's not about that size of leverage. It's about you finding the consistency of getting in, knowing what you're looking for in terms of managing the risk, in terms of the points or pips, not the money. Not the money. The money is a derivative of doing the right things. In the beginning, you need to focus on doing the right things. The logic needs to be there, not the reaction emotionally and psychologically to fake demo money. Don't do that. You're actually causing yourself barriers. It really is creating a barrier for you to find success if you do those things. It feels cool. It feels fun. Like, yeah, if I would have been a real trade, I could have made this much money. But you didn't. So let that be the reality. You didn't. So you're really tricking and conditioning yourself improperly, which is the opposite of what I teach my students with backtesting. Whereas I teach my students when they do their backtesting, in their annotations, they write in there as if they saw the trade happening beforehand. And by doing that, it's like self-talk. You're speaking to your subconscious, and your subconscious is going to refer back to that as a false memory. Because it's a positive reinforcement, it teaches you because of pattern recognition and over again being exposed to the same elements, and you're reinforcing yourself with your own comments and your own cheerleading. You're fortifying your expectations going forward on this pattern yielding something in the past. Not that it's going to absolutely work in the future all the time, but we as price action traders, we look for signatures that repeat. Nothing is guaranteed that's going to repeat. That's why we have to stop off that way. We know that there's risk in this market. Every market in trading has risk. But if you're going to hone an edge or a model, you need to have a framework. And you start by backtesting. And that backtesting, in your annotations, you talk about how it feels good to see this move deliver as I was expecting from this fair value gap up to this buy side liquidity pool during the hours of this, and this is what my model suggests I should be looking for each day. Notice I didn't say I was stupid, I was playing video games and I was watching some YouTuber talking about some nonsense and I missed the trade setup. I should have known better. Never do that kind of stuff. Not in your backtesting, not in anything that you're recording in your journal. Everything has to be positive. You're sugarcoating everything in your backtesting. You're tricking your brain to see that as experience. So that way when you see it forming live, you're not going to be in fear and trepidation of, oh, it's going to be a painful experience. And again, when right now you don't have the experience yet, but because you keep logging it with backtesting, you're filling your brain up with a lot of pseudo memories. So you're doing the ideal utilization of a lie. This is called what it is. You're lying to yourself, and children love this. You're lying to yourself with positive reinforcement. Okay, so that way when you look at something forming in real time, it will be remembered, and you won't have any negative triggering because of toxic annotations or toxic thinking. You'll have memories of, oh yeah, I remember seeing that, and your subconscious, you may not see it or understand it or feel it when you're doing it, but your subconscious reverts back to those experiences that you logged with positive reinforcement. Don't take a demo account and do that same thing with, I'm going to over leverage my demo account or paper trading account and do a size of leveraging. There's no way I would be able to, number one, put the trade on because I would be too scared because I'm a new trader and I'm going to be afraid of any fluctuation. If I put on $1 million worth of leverage, I can't really sit through the spread opening up on me when I put the trade on initially, let alone weather the ups and downs and initially, as the trade pans out. You're teaching yourself to anticipate a hopeful outcome with ridiculous leverage. And you're teaching yourself that that negative drawdown that you're experiencing is not something to be worried about because you're only looking for the dopamine hit if you did it right. And that video game high score means absolutely nothing in your growth. You've created a speed bump and sometimes a barrier to being consistently profitable. Think. When you do those things, what you're saying is, I'm putting blinders on. I don't really see the real risk here because it's paper money. And I want to show on my video a really high profitability in the end result because you want clout. Every single time, I see one of my students, whether from the YouTube community or some of my mentorship students that are in private group that have YouTube channels, they'll make a video and they'll use really high leverage, but they may have executed extremely well. Manage the whole thing from beginning to end. My comment consistently is, next time, even though I've commented and said, well done on the other stuff, I will always tell them, next time, use realistic leverage. That's my only criticism. Not because of me trying to kick the legs out from underneath them. I'm not trying to steal their steam or their drive or motivation. I'm being the best influence I can because I don't want them filling their head up with things that are toxic because that's what that is. It's all about clout. You don't want clout. You want consistently profitable. Trust me, being consistently profitable feels a whole lot better than clout on the internet. I don't need everybody to love me. Look at me. I've been here for a long time, and there's a lot of people that hate me for no justified reason. But the point is, none of that stuff causes me to lose any sleep. So don't invite those environments where other people can influence your performance, your expectations on yourself, your model, your trading. None of these jokers on the internet should have any influence on you. None. They don't have it on me. Why? Because I have deep-rooted sound logic in the things that I'm looking for. You all are experiencing that. You're seeing it firsthand. You're seeing it. And it's encouraging. So don't make the mistakes of adding these little things, these flavor enhancers to your experience, okay, and calling them something that they're not, because they're not going to make you better. They're going to actually hurt you by over leveraging just because you want to see big numbers show up on your trade. Everybody watching knows that you put a demo trade on. Everybody knows that you put a paper trade on. They know. So don't, parade around with it like it's a big deal. It's not. So the way you make it more respectful to your viewers and also remove the element of clout chasing. Use the smallest leverage. Let the people that want to heckle, let them heckle. You worry about being consistent. If you want to showcase your skill set, do the executions and use the lowest leverage possible. And let that be the example that you're showcasing. So I think I've gone through a whole laundry list of things I'm supposed to cover tonight in this. And I know it's a very, very long video. I know it's probably long-winded for some of you to like to see me get right to the point, but this whole thing was at the point. And it really is a clinic on how to operate and engage the marketplace using what I'm teaching, even with what I'm teaching in the YouTube model. And I'm just so thankful that the community has really received it well. The comment section is just a love fest, and I absolutely love it. Please don't call me the GOAT. I won't ever heart your comment if you do that. It's not that I'm ignoring you. I just never do that. Don't call me a king. I don't like those things either. Appreciation or the things that you've observed in your own development. I love reading those. And I just thank you for all of your support of the channel. I think it's wonderful. I think the community is growing, and I think it's just a healthy experience for all of us. And I'm finding a great deal of pleasure doing it, which is what I was hoping I'd get from it. So 228,000 followers. That's pretty crazy. Like, it's really growing fast. At this pace, I'll probably have a $250,000 by the end of the year, which is really nuts. But thank you very much for your time. Hopefully you got something from this one. And until I talk to you on, hopefully tomorrow, I guess it will be on it. So I'll have another video up on YouTube tomorrow night around 10 o'clock. Until I'll talk to you then, be safe. All right, folks, welcome back. I guess just like yesterday, last time we spoke. All right, so here we have one of those instances where, as luck would have it, the hands of fate, the planets aligned, all those factors came in on something I gave you in analysis last night. Now, before you start snickering or rolling your eyes and sending your husband up to slap me on the stage, just understand that this is just one little piece of price action and the delivery that the algorithm will likely, not every single instance, but it will likely repeat. Okay, it's the logic that I've shared on this YouTube channel, and I've been asked, obviously, if you read the comments in the videos, can I show an example of this working in London session for Forex? No problem. To do that, I set the stage with the analysis last night. There are folks out there that will say, I don't know how to pick the tops and the bottoms or the highs and the lows of the day. They don't know what I'm teaching, so it's easy for them to say those types of things. And a new student may stumble upon their comment, may stumble upon their YouTube channel, and whatever their medium is, they follow that logic without investigating it or looking into whether or not these things that I claim are true. So without a safety net last night, I outlined it for you. I explained what it should do, why it should take place, and therefore we watch. And do I see in my chart, like you should see in yours, what I outlined? Not exactly to the level I was outlining, but the general premise was there. What do I mean by that? Well, we were in this area here, and I mentioned that I felt that it was going to go below the 100 level. And if I were making the market, in other words, if I was the market maker, providing the parameters at which the dollar index will go down to set up a buying opportunity, I would take it down to the 99.92 level. Okay, and you can check me on that with the video uploaded, and I can't edit a video on YouTube. Once it's there, it's there. Okay, so I know some of you are actually downloading them. That's fine. But go to episode 19, which is the one I just did last night, and listen to the 20-minute mark, around 10-second in that vicinity, and let it play for a minute or so. And you'll hear me outline the very thing that you're seeing in your chart right now. So the question is going to be, how did I know to call that level? And why did I know that it was likely to set up a London setup? Well, I'm going to teach that to you tonight. So understand, this is not the model for my daughter. This is not in addition to the model. I'm just simply answering questions because I got a lot of them, and I'm not trying to push this inside of the model for this YouTube mentorship, because the next step is going to be, can you go into London and do live sessions so we can copy what you're doing? I'm not going to do that. Okay. Now some of you are going to be upset, say, oh, well, see, you're not proving anything. Well, if you're not seeing this as proof, move along. Okay. Just move along. I'm only going to do what I'm going to do. Okay. And I'm having fun showing what I'm showing, and it's really enough. Only those individuals that want to be spoon-fed setups and trades and piggyback my ideas, they're the only ones that really push and twist my arm, and they're going to be frustrated. So I'm just letting you know that's not going to happen. So don't ask. I don't care how many times you present it nicely in a comment or request. It's simply not going to happen. It's important for you to go in and find these setups on your own using what I'm teaching. So I mentioned that we dropped below that 100 level. Why did I pick the 99.92 level? Okay, well, if you look at the price action right over here, okay, we had this run up at the beginning of that candle right there. Just draw that out in time. I gave you about 99.95, 99.92 level. Okay, a small little range of about 3 pips. That's what I was eyeballing last night. Now, I was talking to you, obviously, before midnight. Now, there's things that I teach and have in my repertoire that helps me fine-tune the low of the day, and I'm not going to teach that here, and because I have a community, obviously, I'm obligated to. I'm not obligated here, okay? So I don't want you thinking you can guilt me into doing more than I'm already willing to do, but just know that there's things that I can basically use in my repertoire at midnight that will help me fine-tune the actual low within about 2 to 3 pips. Sometimes right on the very low, but it's not needed, okay? The idea that I just gave on the fly last night when I was doing the commentary was really simply just reading on the idea of this extension and ending it right on that candle's high, and just eyeballing it. So that's what I was looking at. I expected it to drop down. I'm not convinced that we're going to see this top yet. So I felt that it dropped down here. And also, being a setup going into London, that's what I would expect. And I'm going to teach you how to use that information if that's what you want to investigate and study on your own. But notice that we ran above these relative equal highs, and that's what we ran for the intraday price action target. So the high of the day that was set initially around the midnight time frame, it dropped down, creating the entire run lower, creating the London low, real close to where I was outlining. Not exactly, obviously, but it's good enough for government work. And the market starts to rally and it takes out the initial high of the day. But more specifically, it aims for these really clean levels. You have this high here, here, and here. Remember I was teaching? Just like this level here, the market does not like to leave that. That is not efficient. Now, it's efficient for technical analysis, Retail 101, where they'll see that as resistance. It looks perfect. That's what they want, because the books teach that. The books are meant to trip you up. It's flawed logic, folks. I mean, I hate to say this type of thing to certain individuals because they take aim at me like I'm trying to belittle everyone else. It's not that I'm trying to belittle anyone else. I'm trying to shake you by the lapels and simply say, look, listen to what I'm saying. Don't believe what I'm saying. Investigate the things I'm stating in the video. So that way, you can come to your own conclusion. Either I'm making things up or there's really logic behind it. And you can dismiss 99.9% of the things out there that everyone looks and relies on to have in your charts as far as analysis concepts or indicators. You don't need all that stuff. So if I'm suggesting, as I mentioned last night in the video, that we would drop down here and then start to go higher, that sets the stage for what? If this is going to be a point at which it reacts and goes higher, as I was outlining around this time period in the video, that means the opposite should be seen for Euro. But before we get into that, let's fine tune this a little bit more on the 15-minute time frame. You can see we drop down during the low of the day in London Open. That's our kill zone that I teach here on the YouTube channel. It's 2 o'clock in the morning to 5 o'clock in the morning, New York local time. So if you are using the time window thing over here, set it to local New York time, 2 o'clock to 5 o'clock in the morning, that's the kill zone for London Open. Market comes down, creates the low of the day, runs back up, back into an order block here. I'll let you look at the lower time frames, and you'll see that is in fact an order block. And optimal trade entry, and the market starts to create its run up into the relative equal highs, sweeping that as a daily objective. Now, if this is the low of the day, and if this is what I've outlined in advance, and you see that last night beforehand, this is what I expected to see, price drop down in and then start to go higher. At the same time, Euro runs all the way back up to the previous week's high. How is this likely to be a false breakout? We have to use intermarket relationships like I'm showing with dollar index. So if you're trading Forex, it's important to relate your analysis in the trading market. Okay, for instance, if you're looking at Euro, that's your trading market. You have to have a barometer, something to measure its movement with, and that's intermarket relationships. So having that with the dollar coming down to a level I outlined last night, it would be a bullish area. It'd be a sensitive price point to see an advance higher. Because its relationship with Euro, it's inverted. So if dollar is going down to that level being 99.92, then it's not a surprise to see Euro rally higher as it's doing that. But what is the Euro reaching for? This high, and it went so far as to go up above the previous week's high. So they really reached up in there, took out the previous week's high, and at that same instance, right there, that's when dollar hit the objective I told you last night. That would be a buying opportunity for dollar. If it's a buying opportunity for dollar, then it's a shorting opportunity at that very moment. Look at your own charts and study the moment it hits this level here. It's the same moment that the dollar index is hitting that area I was outlining last night for a buying opportunity for dollar. So this is a false breakout because my analysis was done and shared with you openly that would be a buying opportunity for dollar, setting the stage for what? As I outlined, I'm bearish foreign currency. Could I have bought that? Sure, because I'm expecting the dollar index to drop down to that 99.92. Did I? No. I went to sleep. I was tired. So I'm not concerned about that. I didn't take the short either. I don't care. I don't want to be in every single move, and I'm not trying to trade Forex right now. But to prove to you folks that are sitting out there asking to see if it can be done in London, does the concepts work? Can I call a move? Can I give an idea? Can I do these things before it happens? Yes. but simply because I can doesn't obligate me to. Okay, I'm not here trying to perform magic tricks for you. Okay, I'm not trying to do that. I'm trying to teach you to trust your own analysis and lean on your own experience, even in the early stages when there isn't that much of it. It's okay. You learn to grow gradually. All right, so the 15-minute time frame. You see that the euro went up into its kill zone here, 2 o'clock in the morning, 5 o'clock in the morning, New York local time. So it creates the high of the day. So in this price run, we're going to start stripping it down. I'm going to make it very easy and not make this video very long. I'm going to jump right to a very small time frame chart. 2 minute has the very clean fair value gap. So after it ran above that old weekly high, the market trades lower and takes out that short-term low. Now, some of you might see this short-term low and say, well, why did you use that low instead of this one here? Well, the reason why is the fair value gap forms right here on this candle. Once that candle closes, the very next candle, it opens essentially right at that low. So it hasn't really moved away. It hasn't really shown me what? Displacement. Something energetic where it moves away from that fair value gap. That's the important factor. So we have the fair value gap here, and then it moves lower than that short-term low. Now we have a shift in market structure. The market could have came back up into this run here and offered an entry there, but it didn't. Notice that. It went a little bit lower. That's fine. And then rise up to that level here. This is the entry point. Now, think about where your stop loss would be and think about where your entry would be based on what I taught you using the New York session. This is an opportunity to pause the video and think about before I show you annotations. You're smirking, aren't you? Thinking, I'm not pausing it. So you just might as well get on with the ICT. Okay. So here we have a zoomed in 2-minute chart. And here is the fair value gap level that you would be putting your limit order in. So it gets filled essentially right there. Remember, it's not going to be placed in the marketplace for a shorting opportunity or entry on limit anytime in here because it has to move away from the fair value gap. So it does it on this candle here. So we have that run through this short-term low. We have displacement. There's energetic. Move lower away from the fair value gap. It doesn't get to it here. It goes a little bit deeper. We wait. We don't chase it. We don't go in thinking, oh, well, I missed the move. We still have time. See all this over here? The kill zone for the London Open is still open. So we allow for that retracement higher. Your fill here, maybe 1 pip at, maybe a half a pip, or maybe a full pip above this candle's high. That would be your entry, but we're just going to use the actual candle high. That would be your limit order entry, hypothetically, 1.0924 and 4 pipettes. That's your entry. Your stop loss will be above the high here. That comes in at 1.0936 and a half. And the heat or the drawdown that you absorb, hypothetically, if you would use that entry point, is 1.0931. So basically, not even 5 pips. Okay, so, well, about 5 pips, around about 5 pips of drawdown. So essentially 25, we'll call it the 30. So call 5 pips, there it is, done. So 5 pips of drawdown, and never came to your stop. With this gearing, okay, if you use sound money management, how much can you risk if you're risking $1,000 per trade? Okay, you're thinking about money-wise, don't do that. You think about it in terms of fixed percentage risk on equity. So that means you're simply going to look at how much money you have in the account, take that, times that by 1%. Okay, 1% is the maximum. Preferably, you should be doing a half of 1% or maybe a quarter of 1%. You're learning. You're not trying to do a lot in the beginning. You're trying to just simply trust the idea of seeing these moves. None of you should be going to the demo. None of you would have done this, obviously, because we're talking about in hindsight. But I'm showing you the relationships of how when the market went to this level here and created 5 stops on the previous high, 1 euro, that's the very moment that the dollar index went down to the level I outlined. It would be bullish. So the teeter-totter effect or the inverse relationships, that if the dollar's going to go higher, that means that it's going to have weight introduced to euro and it should start to go lower. So your entry here and your drawdown and your stop, all those being what they are here, we go out a little bit further, and I'm just using a 5-minute chart so I can put everything in the fractal. In other words, the fractals just move up and then down. That way you can see it all and have the candles still be clean and have everything on one chart. So that's the only reason why I'm showing the 5-minute chart. It's not that I'm doing anything special with it. Okay, it's just to show you the overall dynamic of this price run up, the rejection, the optimal trade entry that would be used with the fair value gap used on the 2-minute time frame, all the levels and things here being as they were on the 2-minute chart. And if you did a Fibonacci run from the low here, why this one because it was most energetic starting this price run here, that would be your apparent price leg. 50% is around in here, so that would be a nice objective initially. That would be your first target. If you're gonna hold for the full day, it could go down to this area here, and lo and behold, we have that imbalance. You trade right into that rather handsomely. So there's your example using it. I gave you the framework beforehand. I told you what to expect in the dollar index, and everybody should know that the euro is going to be the opposite direction of whatever the dollar's going to do. So hopefully this has been insightful to you. You got something out of it. So I'll talk to you next time, next week, next Tuesday actually. Lord willing. Enjoy your weekend and be safe. All right, folks, welcome back. This is our 21st episode of the 2022 free ICT YouTube mentorship. Little tongue twister there. So we're looking at the hourly chart on the dollar index. Why are we here? Why are we looking at this? Well, I'm looking at this because I want to show you the relationships between a risk on and risk off market. If you've been following along in the comment section, and if you haven't paid attention or even noticed, all my videos in this mentorship, the comment section is open. Okay, so you're welcome to make your appreciation known. You're welcome to, prompt me with specific questions that you want to see me kind of like touch on without making too much of a long-winded request for it. I can kind of get a feel for what you're looking for, and I'll work those ideas into the lessons so that we can hopefully get everybody's understanding on the same page. I may not respond to your post. I may not, directly answer you. Sometimes if it's short and easy, I'll do that. But if it's a question I see a lot of across the other videos as well, I use the videos to kind of like answer it. So it's important you take notes because usually you'll find that the questions you have are answered in the progression through this mentorship if you're coming here later than 2022. All right, so one of the questions I got, and I get this a lot for people that have not been trained by me, the idea of using the dollar index, is it useful like when I look at the forex market, like if the dollar's going higher, obviously that's going to put pressure on the foreign currencies, be less likely for them to have sustained rallies. They're more likely to have sustained declines. So dollar up, foreign currency down. Dollar down, foreign currency up. The reason why that's occurring is it's a risk on, risk off scenario. Dollar, if it is going up as we have here, this is a risk off scenario. Okay, risk off scenario implies that generally every other market or asset class will start to decline. And this is treated as like a flight to quality, okay, or a safe haven. So money pours into the dollar and it pours out of risk assets. That would be like foreign currency. That's why I've been telling you to look at the euro dollar to go lower and make a new low on this daily chart. And today it did. I know it's random. And then also this applies as well to the stock market and index market. So obviously I'm kind of like pushing the index futures in this mentorship on YouTube, but it's applicable. Obviously, everything I'm teaching here is universal, so it works in everything. Now, I'm not co-signing crypto. As a reminder, I do not trade cryptocurrency. I have absolutely zero experience trading cryptocurrency outside of a demo account or paper trading account. I've never done anything with it. I've never opened up a crypto account. I have no interest in ever going into the asset class, and there it is. Okay, I see a lot of you asking that in the comment section, so I'm going to try to throw this out there every now and then as a reminder because I don't do anything with that asset class. I have a lot of students that trade them, and they swear by my concepts working there, but I personally don't do it. Okay, so there's that. I'm a forex and futures trader, so that way you guys can know what my specialty is. And I want to show you this chart here and remind you of what I mentioned in the previous week in our meetings together in episodes. I said that we would likely see the dollar index drop down. If I was making the market for the dollar, I would see it go down to around 99.92. And you go back and listen to the videos, and obviously you'll see it. It's there and hear it. And I said I would run the relative equal highs and start to run it higher. I gave you the objectives of relative equal highs and mentioned like 102, 103, and even my private mentorship group knows those objectives as well. And we have it here. Okay, so I'll leave it up to you whether or not you find this inspiring or not, knowing that this was likely to occur for a London setup and then rally higher. I want you to look at the relationship between this price move here and go back in the commentary where I was referring to that daily bearish order block on the index future. Okay, so I was talking about the low of the daily order block, the open of the order block, and the mean threshold halfway, and then the high of the order block being the less likely level to be traded to. And I'll talk about that when we get into the E-mini S&P portion of this episode. But for now, let's take a look at what the relationship looks like with the dollar versus the E-mini S&P. So this is the June contract for 2022 of the E-mini S&P futures market. And you can see as the dollar creates its important low that I called publicly, you guys know it, I've said it, I've explained it to you in detail. As this dollar was going higher, what was going on in the E-mini S&P? See that inverted relationship there? That's why if you go back and listen to the recording, when I was talking about that bearish order block on the E-mini S&P, I said that we're going into May, and it's usually a seasonal decline, and I'm going to be looking for signatures to warrant downward pressure in this particular asset class and reaching for those relative equal lows on the daily chart. Hello, look at your chart, folks. This is what it's like to be mentored. This is what it's like to know what's likely to occur with tools that make sense. There's nothing ambiguous here. There's nothing, splattered across the chart. It's just simple, sound logic. Okay, I'm hopefully inspiring you to simplify, which many on the outside looking at what I do will make snide remarks like, oh, he overcomplicates things. And I'm not complicating anything. These are very simple ideas, and it helps you build the idea of bias. It gives you intermarket relationships and intermarket analysis to give you the trust. Okay, why did I feel confident to publicly say that 99.92 level? Well, I explained that. Why did I think it was going to rally from there? Because I'm bullish on dollar. Why did I hint that we're going to be going lower into the E-mini S&P relative equal lows and as we enter into May? That's a seasonal tendency. So all those factors came together. In my experience of almost 30 years, was used to hint at something for you to study. And if I'm right or if I'm wrong, you get to be a judge. Okay, you get to see and weigh me in the balances. I've laid it out there in your hands. You see right now in this chart what I was forecasting, the reasons why I was doing it, why I said what I said, and why it looks like it does in your chart today. All right, so here's that daily chart, and here's that bearish order block I was referring to. And the high I said is the level we don't look for it to be traded to, and you can see we didn't even get to it there. Okay, so we got up into the order block, and then we had the weakness that was expected as we go into that May month, and we're reaching into these relative equal lows. That's the next draw on liquidity, but for now, again, just keep your study inside this order block. That's taught in this YouTube channel, okay? So while it's not a main factor in the model I'm teaching in the mentorship for YouTube here, I leaned on that as a basis for my analysis. Why I felt this was likely to go lower, that's the order block. That's the one that makes the likelihood of the market turning in this area and then going lower and attacking the sell side below here. Below the relative equal lows here is next, and then this low here. So ultimately, we're looking for a run below here for the sell side. Now, it might want to go down below here and give a little bit of retracement. If it leaves this portion open, that might want to rally from going over here up there. I don't think it would do that personally, but it could happen. But it's likely to draw into that old low here. Now, how we trade once we get there, that'll be interesting because I don't know if it's going to accelerate violently to the downside or if we're going to have a sharp retracement higher. I don't know that. Okay, I don't care to know that. Right now, I'm just looking for and submitting to the idea that we're going to keep drawing down on the daily chart. Each daily candle should be expanding lower and reaching into this area. Okay, that's what I'm expecting. That's my ideal scenario. Now, if you look at the daily range here today, we had a little bit of movement above the previous day. So we rallied above Monday's high and then failed and accelerated to the downside. Fell short of just running below these relative equal lows, but I still believe that's where we're likely to go. Had a little bit of consolidation in here, dropped. Then we had a nice rally in here. Now, admittedly, listen closely, folks, because this is one of those times where I didn't get it right, and I have no problem telling you. I was expecting this to rally just a little bit higher and maybe flirt with that 43.20 level. I thought that we could get one more spike up into that, and then I was expecting to roll over and go lower. That did not happen. Okay, so let's go into the lower time frame, 15-minute time frame. And here's the midnight hour, New York time, and the opening price there. Notice we only had 1, 2 little moves above that, and that's a really anemic movement for what I was expecting, a little bit more pronounced rally higher. I wanted to see a little bit of Judas swing, about 20 handles, 15 handles to that effect like that, and then break down and create something like this. Okay, but we didn't get it. So some of you may be asking, and I believe it was Michelle in the comment section, mentioned that it didn't appear that Power 3 was in effect today. It actually was, but sometimes it's really, really small little movements like this, and it may not be useful to you. But what happens is when you enter the London session, which we do here, on 3 o'clock in the morning, it breaks down relative to New York local time. Okay, so 3 a.m. New York local time. There's a lot of folks in the comment section, they're referring to and confused about daylight savings time and such. All of that is resolved if you simply just listen to the instructions I gave every single time I mentioned the time aspect. If you use this little area down here on TradingView and toggle it to New York, And all you do is by clicking it, a window will pop up, scroll to where it says New York, highlight that one, click it, and then you're set. You don't have to worry about it. Don't worry about daylight savings time. Don't worry about, anything. As long as you are aware of what local time is in New York, set a clock on your computer that always tracks the local time in New York, 24/7, 365 days a year. If you do that, you'll never have any confusion about what you should be doing relative to time, okay? So if you have a small little movement like this, it can throw you off if you're expecting, like I was. I wanted to see a little higher rally. So in the morning, I was looking for maybe a little poke above here. Didn't happen. We broke down, retraced back in, bearish order block, and the imbalance, and spent a little bit of time here, and then rolled over right before the 9:30 opening. Okay, and I'm gonna talk a little bit about the 8:30 and the 9:30, what times are useful, what are beneficial to your analysis, and what you should be concerned about. Okay, because there's a lot of questions about that. But ultimately, we moved into the lunch hour, had a little bit of retracement here, broke down once more, and then aggressive selling, really aggressive selling into the PM session, into the close of the day. If you look at the opening price at midnight local time, New York midnight local time, that's what this here is. That's that opening price. This price is useful for trading the London session. That's 2 o'clock and 5 o'clock in the morning, New York local time. And it helps me frame the power 3 for the daily range. If I'm bearish, I'm looking for something to rally above that opening price in London. That's my ideal scenario. I'm looking for that personally. As you can see, we really didn't get much of that today. It was extremely heavy and just wilted and went lower. Sometimes that's going to happen, folks. And in this instance, I missed a setup. I don't get in what I'm thinking I'm expecting to see. So I'm human. You're human. You're going to look at something in the chart and you're going to have something that is your favorite model, whatever pattern is you're looking for. And it may not even be my stuff. Say you're just here casually watching. You're probably nodding your head saying, yeah, I've had lots of instances where I was looking for my particular setup and it didn't materialize and it went the other way without me. You're going to miss moves. You're going to misinterpret it. You're going to read it wrong. And that's going to happen. That's why you have to use a stop loss. That's why you have to be controlled about how many times you go into the marketplace. And you also have to have some measure of flexibility. And that comes with experience. You're not going to always be able to see that this isn't going to go up for you initially. It's just going to just wilt and go the other direction. So when we get into the 8:30 hour, and I have the lines really light here because I want to be able to show where the highs and the lows were on the respective candles. So this is the 8:30 and this is the 12 a.m. midnight candle at New York. So this is New York and this is midnight New York. So there's a distinction here. The beginning of the day, this is where I look for the daily range power 3 setup and or the ideal scenario. If I'm bearish, I want to see something rally above that opening price. If I'm bullish, I want to see it decline below that opening price. Okay, that's pretty much the basis for the opening price at midnight. It may not be a factor for you, like it is here. It's not much of a use, for anything except for, well, here it opened and it just basically went lower from there. At 8:30, the same thing. I look for those types of scenarios. I'm looking for weaker prices. I'm looking for it to trade lower. And does it rally above the 8:30 opening price? It never does. It's too heavy. It just wilts. Okay, it keeps going lower. Now, the opening price at 8:30, I use that for, again, power 3 for the New York session. The same thought process I'm using for the opening price at midnight in New York time. That opening price, if I'm bearish, I want to see a move above that. That's what I dub a Judas swing, a false rally, or a suspect rally. I usually like to fade those types of moves. As it goes up, I sell right into it. It's scary for someone who doesn't understand what you're looking at. But if you know what you're looking for, and it takes a lot of experience and learning and back testing and seeing things, you'll be able to do those types of things over time. But that same element of trying to look for a short above that opening price in New York when I'm bearish, I would expect the same thing to happen for the New York session, a rally above that opening price at 8:30, and then decline. So I'm looking for something to rally above that and fade it, but it isn't doing it today. So now look what's occurring here. This is really important that you understand this part of it. You know that I've been bearish. I've made it public knowledge here. Did we rally above the opening price at midnight? No. Did we rally above the opening price at 8:30? No. And we're bearish. What does that indicate to you? Obviously, with the benefit of hindsight, it's extremely bearish. It can't even rally to a short-term premium above the opening price at key levels and time. So we have an extremely heavy bearish market. So it's not going to give us these stunning little short-term rallies that we can fade. It's just going to stay heavy, and either you get in where you can find small little pockets of imbalance, or you miss the move entirely. Now, as it happens today, my wife went on a trip. I had to take her to the airport. I was only able to capture $2,000 worth of movement in the S&P E-mini. That's the only thing I could capture. When I got back, I didn't participate in the afternoon, and looking at it now, I missed a really, really huge opportunity. There was no trading whatsoever in the afternoon. My money was made short on E-mini S&P in the morning session, and that's all I had for today. If I would have just held on to what I had in the morning, I could have done around $12,000 today alone. But I didn't hold on to it. I had other things to take care of, and that's the reality of things. Real life creeps in. It's going to happen. But for those of you that are trying to learn these concepts, these types of movements are going to be very frustrating in the early stages of your development, because you're going to feel like they're changing something. They're aware of this. This stuff goes on a lot. It happens in the futures markets, like commodities like corn, soybeans, gold, oil, stocks. Sometimes the markets are just simply too heavy, and they're not going to rally for you. Okay, to short into. It doesn't mean that they've changed anything. It doesn't mean that the concepts don't work. It just means that this is a market that is extremely bearish. And when it's extremely bearish, you have to trade it differently. And I'll show you what I mean by that here. And I'm not trying to inspire much outside of the mentorship, but I know some of you have asked this in the comment section. Plus, it helps my own personal group to understand this as well. So it'll be a little bit of a refresher for them. All right, so here's the London Open setup. This was the move that set up the only real sound entry, in my opinion, that took place today. Here, this displacement, fair value gap, rallies up, bearish order block, fair value gap, runs into it, and then you hold it. Because of the microstructure, shifts below the short-term low, the imbalance, we run back up in. This imbalance here, remember when I talked about this? This one here can be traded to on a spike. It can get up in there, but your entry is on the lower fair value gap. Do you see the logic working here? You are going to use a stop that's going to allow for the market trading up into this one. So you may not like that much risk. You may not be able to take this trade. That's all part of this game. But you can trade a micro, or maybe you could. I shouldn't say that you can. I don't know what all of your risk parameters are, what you can work with in terms of margin. But while you're learning in paper trading, obviously you can use anything because it's all hypothetical money, and you're learning the skill set. But the rules are still sticking to what I gave you in terms of the logic. If you have two fair value gaps, you're using this as the entry and you're using this as the risk. Don't always assume that you can get up here and get the best entry because it never went there. See that? So it's things like this. This is what I refer to as a signature in price action. These are algorithmic things that repeat, but you have to have the discernment and experience to know when it's likely to occur, when it isn't likely to occur. So anyway, let's talk a little bit about the 8:30 time period and 9:30. All right, so here's 8:30. Got the imbalance here after 8:30. Now, normally with the model, I'm teaching you to look for something to the left prior to 8:30, some kind of short-term high. We want to see it rally up. And using the opening price at 8:30, which is here, we want to see it rally above that, run some stops, then break down and create this type of scenario where it has displacement and an imbalance. It rallies back up into the imbalance and sells off. The model doesn't exist in today's price action on the 5-minute chart. It doesn't give it to you there. Okay, so I'm going to give you coaching, if you will, to kind of like show you what was in price and some of the things I was looking at to help get in sync with the move, but I didn't ride the whole thing out. Okay, and believe me, I'm looking at this today, wishing I just would have had at least one of the two contracts I had on still and just let it run, and I could have done about $8 grand or so. But I didn't do it. Okay, I was leaving. I was taking my wife to the airport, and it's just better if you're not going to be in front of the charts and anything can happen. You have to get delayed out there. The phone doesn't connect with the the broker. It's just better just to be away. If you're not going to be paying attention to the marketplace, just simply completely close the entire position. Also, I'll throw this in here too. Shortly before I started doing the recording here, I saw a question: do I ever hold overnight in these current conditions? I stopped holding overnight like 24 hours years ago. We had a lot of things going on in the world that changed my trust. Just like I used to hold things over the weekend and expect continuation going into the opening on Sunday and Monday, I no longer hold over the weekend. So I am 100% in a session or a day and out before the close. Like I'm not holding 24 hours. I'm not holding 12 hours. I'm not doing those types of positions. Typically my trade is anywhere between 90 minutes to 2 hours maximum. That's about the length of time that I'm holding. And I'm looking to take mine and get out and then reassess things because it's just too much risk right now in the marketplace, all asset classes. And things are now starting to get a little wild and it could get a little bit more wilder. Okay. But the 5-minute chart has the imbalance in here. We saw that run. And the model, I want to see it run above the opening price at 8:30. The opening price at 8:30 is the New York Sessions opening price. Now, don't get confused with the New York Midnight Candles opening price because the New York Association in the name, New York Session is the 8:30 to 11 time period, New York local time. So I'm looking for this framework to offer Power 3, which is a fractal element of accumulation, manipulation, and distribution. That's what Power 3, the three things that is empowering you is understanding those three elements. Accumulation, what's accumulating? Short positions, okay? Why? Because it's bearish. So smart money would accumulate short positions, then anticipate manipulation above the opening price. They would assume more short positions there. Then it starts to go the other direction, and they distribute their short positions at some important low that we're able to forecast. And obviously, it's relative to those daily equal lows and old daily lows and projections with the fib. All those ideas come to mind in concert with, in agreement as well, with time of day. Okay, so we're looking at a movement down into around the lunch hour beginning at noon. Okay, creates the important low there, and then retracement during the lunch hour. One more time, it punches above the high here, then it breaks down, consolidates, starts to create 1, 2, 3, and then you can expect continuation going into the afternoon session. We're not going to talk about the afternoon session because honestly, I wasn't participating in it, and it is what it is. I'm familiar with this morning because I had some horses in the race today. Okay, so we'll start getting a little more detail here. Here we have the 4-minute chart. The imbalance here. This is one, again, that is not rallying above the opening price at 8:30. Now it's showing 8:28, but that's because I'm showing a 4-minute chart. So don't let that confuse you. But the opening price, again, never got traded above at the 8:30 candle. So whatever that opening price is at 8:30, you extend that out in time, and you want to see that rally above. Now, when you have this expectation, the other aspect of time is the 9:30 opening. That's when the equity market or stocks themselves start trading their New York session. So what happens at 9:30? What am I expecting at 9:30? Well, number one, 9:30 is just when the opening occurs, and there's initial volatility. Now, it could be whipsaw, where it can go up and down real short term and go both directions in a small range. Sometimes it can be a really large range and clear both sides of the buy and sell. And then, whatever the real move's going to be for the day, we wait for that to unfold. Today, we can see at 9:30, it just starts to run lower. It doesn't give us a rally at all. So it just starts to speed up what's already in motion from 3 o'clock in the morning during the London open session. So at 9:30, all it does is start to accelerate down. Okay, and the same idea is being shown on the 3-minute chart. You can see here that middle imbalance gets a little bit more refined, trades up into it rather handsomely, breaks down, and here's another fair value gap with a bearish order block. And this is one in here where it's useful because you have a little bit more insight as to what it's doing. It's too heavy. It's not likely to rally. There's no reason to look to go long. Start looking for reasons to get short. And anytime you get an imbalance and we're above those relative equal lows on the daily chart, because it's going to draw down into that. That's the heaviness objective. Okay, why the prices keep going lower, 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 lower is because they're gravitating towards those relative equal lows on the daily chart. Okay, so go back to the chart where I mentioned in this video and show the daily chart. I have that little blue line. That's where price is being drawn to. Okay, the algorithm is marching every minute, every hour, every day to that level. How long does it take to get there? I don't know that. But I mentioned in my group that I didn't want to see it happen like we're seeing it right now because it's too fast and it doesn't give a lot of opportunities to get in with it and ride it. So you either have to have entries like this, which unfortunately isn't scalable with the model I've shared publicly. But I do have, obviously, opportunities to go over it like this and show you how you can still use the idea of the fair value gap to get in with it. But you're going to have to leave out the element of a rally above the opening price at 8:30. And 9:30 just creates a lot of volatility. Okay, the initial surge in the New York session as the stocks begin to trade it, basically. So as a recap here before I go into the next slide, midnight New York time, that opening price, I use that to trade the London open session. That's 2 o'clock to 5 o'clock in the morning. And also to help frame the idea, like say I sleep through London, which is 90% of the time what I do today. Like I don't do a lot of London session trading. And because of that, when I wake up and I'm looking at the market around 7 o'clock in the morning or so, I'm looking at what has happened overnight. And did we create a scenario that I would be looking to trade if I was a week during London? If it happens, then I know that I'm really built in with an advantage on the daily bias, because if I'm bearish and it creates a rally above the opening price midnight time New York, and it creates that rally, that little Judas swing I explained many times already, and it starts to decline and I'm below that around 7 o'clock in the morning, I know that I'm likely to create another little short-term rally, but it would be ideally above the opening price at 8:30. But it may not do that. And price just remained heavy below both opening prices at midnight New York local time and 8:30 New York local time. So everything was extremely bearish, and it was just so heavy it could not mount any meaningful rallies. Many times in my early development, I got crushed on days like this, where it felt like, okay, it's too low now. It can't just keep going lower. So I'm going to try to buy it now, because indicators told me that we're oversold. 1992, 1993, 1994, I blew account after account after account doing that, and it's frustrating. Now, obviously, with 3 decades of experience behind me, I know what it's trying to do and where it's trying to get to, and it's getting there in a really fast rate of speed. Now, obviously, you can get there a lot faster than that, but I don't want to do that, because it gives no real opportunity for me to engage and participate in, and it doesn't give you, as the student, to engage also with your demo or paper trading account to practice. But as real life sometimes is, it's unfair. Okay, it doesn't give us what we want. Sometimes our expectations and our wants are denied, and in today's climate, that is not popular. And that's why this market and trading these markets is very, very difficult, especially for like the millennials. Okay, that ideal, perfect, always come exactly as I expected, sometimes it's denied. And either you accept that and navigate the markets with imperfection and without the ideal scenario for your model, or you're comfortable with just letting go and not doing anything and being accepting when it comes to big moves and you can't participate in it. There's lots of moves, folks, over the last 30 years that I missed that were huge, big, huge moves. For instance, Bitcoin. I called that thing. I called that thing at 7,500 to 20,000. And then right before 20,000, I said it wasn't going to 20,000. It was 19,700. And I said it's going to go to 6,000. And everybody laughed and went down. And I said it was going to go to 3,000, but it went down to like 32. And then I think a couple times I had it wrong publicly. And then I said that we would go to 20,000 by Christmas. I think it was 2020. And then I said 30,000 by New Year's, and I was off by about 18 hours. It went to 30,000 on the 2nd, I believe it was, on January 2021. And then I said 55,000 and 66,000. That was about as far as I could see it go. And we went just a little bit above 66,000 and hasn't been doing much since. But I didn't do anything with that with real money. So I missed a huge run in something that would have otherwise paid out a lot of money. And I've missed a lot of moves in the futures markets and a lot of commodities. I missed a lot of stock moves, while I was teaching Forex. There's a lot of stock movement in index futures that I didn't participate in. Guess what? It's okay. I'm able to still find trades. I'm not starving. And that's the reality. You're going to have to come to terms and to grip with, you have no way of participating in every single move. And don't think that you're going to find every big move. You're not going to participate in every single price swing. You're not going to, folks. I miss moves. You're going to miss moves, and it's okay. It's part of this game. This business is going to still run and do the same things we're looking for all the time, and you're not going to participate in every move. Okay? So give yourself the permission, okay, to be human. You're going to do it wrong sometimes. You're going to see it for something it's not, and you're going to miss that big move. I had a little piece of this today, but I didn't get the whole thing. I wish I would have, but I didn't. And it's okay. I forgive myself for being a good husband, taking my wife to the airport. I know this is all too much stuff and you don't care. Some of you like to say those things in the comments. Get to the point. The point is, you do this, you're going to have these elements creep in. And how are you going to deal with it? You're going to get mad and go on social media and blurt out and curse and say, these markets suck. No, that's not what you should be doing. You should just reason with yourself ahead of time. Say, okay, I'm not going to be able to do everything. I'm not going to participate in every single move. And this is what happens sometimes. It doesn't mean the model's broken. I promise you, over the next couple of weeks, you're going to see the model delivering like it's done in the past. And it's fine. There's going to be times when the market shifts in and out, and the market structure is just too overwhelmingly bullish or too overwhelmingly bearish. In this instance, the bearishness I gave you guys, this was a lot more bearish than the model would permit for entry. But you can see there's fairly gaps in here you can use to participate. Dropping down to the 2-minute chart, and see again, we find in real nice here. And then once more in here. And then drop down to that noon time, creating an important low, which is what I taught you in this mentorship already. And that 2-minute imbalance you can see on the 1-minute chart here and here. Real nice delivery there. And these are just simple little imbalances to get in sync with what is already in motion, not needing to see it rally above the 8:30 opening price because it's not likely to. So it takes a little bit of courage to get in here and trade these types of setups, but that's what you do. Or you don't do anything and you just tape read. You watch it when it does it and say, okay, I would like to see it drop here. And does it drop? Yes. And you study that. Then gives you another fair value gap in here that's not highlighted and it rallies up to a fair shoulder block and sells off. And your stop is above here. And just because it goes down lower doesn't mean jam your stop loss to here, because that's what happens. You need to have time and price behind you before you start moving your stop loss. And alternate trades obviously lower into that noon time. All right, so I think that's going to be it. The next episode on Thursday, I'm going to show you a couple things inside the trading platform on TradingView that I think are useful. That answers a few things, and one of those students made mention that could I literally go in and show how to set up the Fibonacci. So I thought it was kind of simple already, but obviously some of you are really, really new and you're not familiar with the TradingView platform. So I'm going to add that at the end of the video on Thursday coming up. Okay, so that way it's at the end, and anybody that already knows how to do it, they don't have to go through and watch all that stuff. But I'll give you another teaching and lesson, obviously, on Thursday. Until I talk to you then, be safe. All right, folks, welcome back. This is the ICT Mentorship free YouTube mentorship for 2022. Hope you're doing well. Hope you had a wonderful opportunity to study and learn this week and keeping up with the lessons. So we are looking at the E-mini S&P daily chart. This is June delivery contract month for 2022. And I'm going to kind of like bring you back up to speed to what we were looking for over the last weeks or month or so. Remember back here, we had that bearish order block. I outlined that as an area to watch that, and we're entering a seasonal tendency, so we're going to be expecting lower prices. We got lower prices. I showed you the relationship between the dollar because it's risk off. So we have all the decline taking place in the equities markets. And I said that we would be likely to draw down into this relative equal low. So I'm going to kind of do things in the TradingView platform. So that way, some of you folks that are asking questions in the comment section, like how do I do this and where was this on the platform? Admittedly, most everything I know about TradingView, my own students have taught me. So there's going to be a comment posted and pinned by me underneath this video. It'll be TradingView tips. Okay. If you have a tip that you want to share with the viewers that are new to TradingView, please, by all means, just make a post and outline it as best you can. I'm sure they'll be well received. I might even learn something too. All right, so we're looking at how the market did in fact trade down into our relative equal lows. So this was the draw on liquidity. Okay. Now, when I train my students and when new students come to me, the first thing they want to know is how to pick the right order block, because they know it's one of my concepts. They want to know, which is the entry candle. What's the entry point? Where do I get in at? Okay. And that's the easiest thing out of all the learning. Okay. Once you understand what the market's likely to do, where it's going to draw to, okay, where's it going? Why should it get there? Okay. If you do majority of your studying and watching the tape, okay, reading the tape, which is kind of like what I'm going to outline and showcase in the live streams in May. Just before I get any further in this conversation, the live streams will only be in May. I'm not trying to make an ongoing thing of this. I don't want to promise you, an ongoing thing, but I'm going to showcase some things in live sessions. That way you can see how to train yourself to look for these things. Okay. I will not be giving you trade recommendations. Okay. I will not be entering trades in front of you. I'm going to be outlining basically what you saw me do in this mentorship, outlining where this is going to go, and it went there. I'm going to be doing that with intraday charts. Okay. And I'm going to point out certain areas to study, watch how price reacts right here, and look for this type of thing to occur here, because I want you to understand what it's doing. Why is it likely to do what I'm going to outline? Okay. The best thing that can happen is for me to get it wrong sometimes. Okay. So that way it'll disarm you. It'll feel like, okay, well, if I don't get it right, ICT himself didn't get it right here or there. Okay. So I'm going to do my best, obviously, to try to educate you and show you what I think is going to happen. But invariably, there's instances it's going to creep in that's not going to be accurate. Okay. I'm going to read it wrong, and it's fine. Do not take what I'm saying in my commentaries and or my opinions over the chart that's going to be live. Don't take that as trade advice. Do not take a trade. And I'm going to say this every single time I do the live stream. Don't act on it, because you don't know what I'm doing. You don't know what I'm viewing. You don't know what I'm trying to teach you. None of that. Okay. So you want to sit still and just observe and take notes. They will be recorded. They will be on the YouTube channel for those individuals that are not going to be able to be present. When will those live streams take place? There will be a New York session between, I think I'll start around 8 o'clock in the morning. So that way we can get the chart set up. I'll give you my views overnight, what took place and what I think that counter may present, and kind of like build the mindset. I will not be talking in the chat room. Okay. The little chat thing on the side. You guys will be saying whatever you want to say. I don't care. I'm not going to be looking at that because it'll be a distraction. The agenda that I have for that particular day, it'll be very distracting for me to read comments and questions. And because I know your question is important to all of you, no matter how simple it may be, I'll feel compelled to want to answer everything that flashes across the screen, and it'll disrupt my concentration. So I won't be looking at the chat. Okay. I'm not ignoring everybody for the sake of being rude. I'm just ignoring everybody so I can stay on task. Okay. So there's that. But we'll begin around 8 o'clock in the morning, and we'll close it, whenever I feel the need to do so. But I'll be willing to go up to 10:30, 11 o'clock. Okay, which is a very long session. I know. They may not all go that way. I won't be doing it every day either. So it'll be a handpicked selected day in advance that you'll know about, and I'll post it on the community tab on my YouTube channel. Okay. All right. With all that stuff out of the way, let's get back into the nitty gritty here. So I outlined this area here in this low, and I said this would be the draw on liquidity. So when you're on TradingView, over here there's a little segment where you can have a choice of certain things. Now you can do this, so it looks like this is your bullseye where the market's going to draw to. You're aiming for that, in other words. Or you can use a little magnet icon. I teach with that analogy, like up here. Imagine a magnet of some kind down here, and price is going to be drawn down to that level here. So this is where the liquidity was, and they tapped into it today. Right? You know about it up here. You know about the order block up here. You know about the seasonal tendency I outlined, and we have this really nice decline here. So I'm going to take you into the marketplace and strip this down a little bit and give you some more details. So we're going to the hourly chart, and this is why I do PowerPoint slides. It's real easy to get to where I wanted to be. All right, so we had a run here. Yesterday, just kept pumping higher. Just fell short of this high. And then, so we had a decline, and then the normal pause, and they gapped it down, then rallied back up. So between this candle's low and this candle's opening, right in here, that's an imbalance, coupled with an actual gap. So I want you to take a look at that. Okay. Now, we have this candle here, small little piece of that one here, this one, and this one. They go just above that area here. This is permissible price action. In other words, this is something you have to get used to. Okay. Look at the bodies of the candle. See how they're staying inside of that imbalance? It reaches for liquidity and stops on these wicks. But the bulk of the volume is being held inside this imbalance. Notice that? So now we have the market release go to the downside. And then here is 9 o'clock in the morning. I'm going to go into 8:30 actually. Let's go down to a 15-minute chart. So here's 9:30. That opening price here. At 9:30, what's actually happening is the equities are opening up, the stock market. starts trading, that's when you hear the bell, ding, 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 all of a sudden everybody's clapping their hands on TV, whatever. That's what's occurring here. It's opening. So it's running a short-term high right here, and then breaks lower, creates an imbalance here. So on the 15-minute time frame, what do we see? Did it take a high out? Yes. Did it break below low? Yes. Was it displacement? Yes, it was energetic. Did we trade back up into it here? Yes. So in here, you could be a seller and get in sync with the run to try to get positioned for, if you are a swing trader or short-term trader, this could be your entry and aim for that old relative equal low, which is that blue line here. Remember the 2 equal lows on the daily chart? I drew a line on. That's what this is here. Okay, it ran them into it today. At 8:30, right there, we're using the opening price. Did price trade above it? Yes, it's in premium. It's above an old high. That makes it a premium too. I saw, I believe it was a young lady, and I apologize, I don't recall, and I didn't make a note of your name, so please don't be offended, but I know I saw it where it was saying something to the effect that you don't understand how it could be in a premium because it's above an old high. Anytime the market trades above an old high, that is a short-term premium because it's going into liquidity. Anytime the market trades below an old low, that's a discount. Okay. Now, just like the purposes of what people use overbought, oversold indicators, things can be overbought and still go higher. Things can be oversold or in a discount and keep going lower. Okay. So that's why I'm suggesting that when people are studying price, they can't just assume that an indicator is overbought, so therefore it's a good sell or a shorting opportunity. It's not always. But if you understand the narrative within market structure is not the answer. It helps you frame an idea, but the idea must be in alignment with the present narrative. Narrative is why should the market go where you think it's going to go on that particular day, based on the climate, the economic calendar events, and the volatility that's being offered for that particular trading session or day. So these are all things that you're going to need to study, and I teach on this YouTube channel. And I'll teach a little bit more when we're doing the live sessions because it'll be more practical then. That way you're over my shoulder, you're looking at it just like I'm looking at it, and I'll give you my internal dialogue and kind of what I'm thinking that is the most salient at the moment. So that way your attention is on the right things at the right time. But hour 3, which is the open, rally up, or manipulation, creating a high, and then the movement lower, and then distribute their shorts below an area where there would be stops. So smart money would be selling short the buy stops here, riding this out, and offloading their shorts to sell stops below those relative equal lows. Remember, when we see these relative equal lows on the daily chart, traders are going to look at that as a breakout. There's lots of traders out there that have long-term trend following systems and models, and if it breaks below those areas, they want to be short. So that's going to flood the market with what? Market orders to sell at the market. Well, that's a perfect counterpart to smart money being short up here because they want to buy it at a lower price. And while up here, they're aiming down here. Is it hard to believe that when we were already outlining that last week and the week before? No. We have visibility. We have the ability to forecast certain things that should repeat. If the algorithm is, in fact, in control, and we understand what the algorithm is doing, and I'm suggesting that my experience should indicate that we have that, does it deliver? Here it is. Okay, so you're taking the logic of certain principles and concepts and blending them with market structure. We're looking for lower prices. It should reach for a specific low. But also, how does the present narrative allow for engagement with the daily range or power 3? Everything I've taught you. So it's the open rally. Smart money enters near the high today above the opening, and you get out down here at an important low, and market closes near the low of the day. Let's go into a 5-minute chart. 1, 2, relative equal highs. You see that? Now, if you're looking at the lower time frame charts, let me get this off here. It's no longer useful. If you're looking at that like that, here's the opening price. You know there's what resting above that? Buy side. So buy stops or buy side liquidity is resting here. So it can run up, and just to the left of that also, you see these highs here? They're real close to one another too. So for good measure, they might want to come up here and clean that out. This is a little too much. I think it's too rich for the expectation to get to that high. But in here is reasonable, but here at least, okay? Market punches up through. Yes, it does take those out. Then it breaks down, comes one more time back above the opening price, and then gives up the ghost and aggressively runs for the sell side below here. Now, for some of you, that would be enough. Getting short up here, buying back below the lows, and being done and walking away. There's nothing wrong with that if that's your model. But we're going to take a closer look inside of this area here and see what we see. All right, let's drop down into, I'm just going to go right to the 1-minute chart just to save time. All right, so we have in this area where the market ran above those relative equal highs. Here they are here. Market runs up, then it breaks down right here. See that right there? That's a swing low. Breaks below it. Was it displacement? Yes. Does it mark come back up into this little area here? Yes. Is it above the opening price? Yes. Is that enough? Sure it is. You can be short there. You have to weather this one more run up into your entry, and you may have a little bit of drawdown. But your stop loss, if you're entering this fair value gap, your stop has to be above the very minimum. The candle that creates the fair value gap, that's here. So your stop's got to be above that. For good measure, conservative, up here. Oh, but ICT, that's a lot. That's a big stop. Well, look how volatile it is. You want to be knocked out of the trade prematurely, or are you just concerned about making the maximum amount of money on your trade, dismissing the level of risk? That's what gamblers do. I'm not trying to teach gambling. So when you practice on your demo account, keep that in mind. That way you're not trying to overextend yourself. The sell side below these lows in here, after it hits the fair value gap here, and then one more time into it, above the opening price, it breaks lower and aggressively runs below here. So not a bad little run there. Let's go back up to a 5-minute chart. Okay, and we're going to go look at the afternoon session. Here is 1:35, and I remember I stated that around 1:30, that's when I like to go back in. Now, I paid in trades earlier than that, but I'd like to see 1:30 After 1:30, the lunch hour has been smoothed out, and then there's usually some kind of a retracement higher when it's bearish or retracement lower when it's bullish. And you're seeing that here, the imbalance, relative equal highs. It runs up into that right there. That's an area you can get short on. Market delivers a run lower. Here's another little fair value gap in there. It runs up into that. That's a short, aiming for what? That line here. That's that relative equal low on the daily chart. So today, huge, huge opportunity day. Lots of points that could have been made available. But I did something this morning showing everyone kind of like what reading the tape examples will be like when I'm doing the live session. I did some executions just to prove visibility, to prove I was expecting a certain run, and I believe I was in NASDAQ. Yeah, I was in the NASDAQ. So let's go over to NASDAQ. Okay, that's in here. So we're going to zoom in here on this bit of business. All right, and here is what I had in mind when I was looking at the chart. Woke up this morning. My wife is out of town with my daughter, so I woke up and just because, you know, creature habit, your spouse ain't next to you, so I had insomnia. So I sat up and I was looking at the charts. I said, well, you know what? I see. Well, let me ask you what you see before I do it. Okay. What gave me the backdrop for all this in here, which I'll explain in detail in a moment, but what gave me the realization that this is likely to turn here and go lower? Study the entire fractal that's being shown. Okay. Pause the video. So you just refuse. I'm never going to do it, ICC. Stop asking me to do it. All right, so we had this high here. We ran above it. And then we had the market shift. So buy stops, taken. Breakout orders taken in on the market long. And then relative equal lows, broken. So we have a shift in market structure on a 5-minute chart. In a time when it's bearish, we're looking for those relative equal lows to be tagged on the S&P. And this is not the S&P, I understand that. But the expectation is we want to see these two indices go down on the daily chart. So heaviness should be the protocol going into our trading day. In here, we have what? Displacement below these lows. So there's a lot of energy there. So right above that, what do we have? Fair value gap. Well, there's one right here too. Right. What did I teach you? This is where you do your entry. But ICT, you didn't enter here. Right. I wasn't looking at the chart yet. I'll get to that. He's in my mind. He can read my mind. This fair value gap here, we expect that to stab up into it. So our stop has to at least be in a position where it can weather that. So what does that mean? That means that you have to either have deep pockets and allow for your stop loss to be inside this here, or you use the micros, which is fine. I don't do a micro, man. I'm going to be in here $20 per point. Okay. But you have to have an account that will allow for that. If you don't have that, then trade a micro. But I don't want to do that. Okay. Gamble. But not because I taught you to do that. So here is the order flow inside of that fair value gap here. Again, a little bit of extra runs above into that fair value gap there. I'll put another rectangle so you can get a visual representation of what I mean. I mean, you can clearly see it, obviously, but I want you just to see it by contrast. So this is the rules. This is why I've been teaching you. Okay. If there is only one fair value gap, then you just put your entry there and you don't expect it to go up into any deeper retracement. But because it has another one here, expect it to stab up into that. Now, I know some of you in here want to be an ICT junior and you want to be in there on the highest candle when you're selling, you want to be on the lowest candle when you're buying, and I understand. But this isn't always going to happen. So if you're really only trying to aim for that, you're going to miss moves. And if it moves like it did today, that's a heartbreaker because it moved a lot. And if you weren't positioned in it and you spent the rest of the day kicking yourself about being greedy about trying to get that instead of where I've already taught you, you'll probably miss the other moves that take place later in the afternoon and you get nothing for the day. All right, so anyway, so we have a shift in market structure. We move up into fair value gap here, and we have a break lower, fair value gap here, relative equal lows. Now look real close, folks, okay? Relative equal lows, a high being taken here. We break down. These two candles move right below here. That's the same thing as these two candles here being broken with this move here. It's a fractal. This whole move here is the same thing here, just smaller. And it creates the same thing. The fair value gap here, the market trades up into it. The body's kind of, respecting that low area. Moves a little bit above it, that's fine. But then breaks aggressively lower. Does it take out the low yet? No. Retraces up in. Now I have two, okay? Not one, I have two narratives in play. This one here, where we have a shift in market structure there. So this is a long-term high. Here, we have another break lower, it went imbalance, so it's intermediate term high. This is a bigger one than that one, right? So this is a long-term high, intermediate term high. By definition, they're both intermediate term highs because they have imbalances. But this one's lower than this one. And this over here is lower than that one. So this is a turning point, making this, by the hierarchy of swing points in market structure, this is a long-term high. Intermediate term, because of the imbalance. But how they nest together for market structure, long-term, intermediate term. Now, when this is retracing up, this is going to be a short-term high inside of a market structure that is really predisposed to go lower because we have long-term and intermediate term above me. This should respect the underlying order flow and go lower. And I'm looking for that lower price that's below here. There's sell stops resting below that. So as it retraces back up into this up close candle, what is this up close candle? It's a bearish order block. That's not what you've been teaching us, Mike, on this model. Right. I didn't say that's what this was. I'm telling you how to read the tape, okay? But I do teach order blocks on the channel. So we're going to go into this right here. So inside this shaded area, this is what I'm going to be executing in. Not with that color in. Okay, that's good enough. May not be your choice, but it's mine now. All right, so we're going to drop into a 1-minute chart. Every time I do this, I always imagine somebody has a little bit better understanding how to work with the TradingView platform. they probably have a whole lot easier, quicker way of getting to where I'm trying to get to. Sorry. All right, so we're inside of that blue shaded area on the 5-minute chart. I'm also inside of this green candle here. That's a bullish order block. So what I'm doing is now I'm going to calibrate, which just simply means I'm going to go down and, with a top-down analysis approach, refine that order block that was on 5-minute down to this one. So the market retreats back up into here, into that order block. And I'm trying to aim, once it hits the midpoint of it, I want to get in around that time. Okay, so I'm entering there on that candle, and then I'm holding in all this, and it drops back down. Now, some of you might look at this and say, oh, but this is that order block, fair value gap here, and what happens if it rallies? Well, it does a little bit, but what's it subordinate to? All the things I outlined over here, and on the 5-minute chart over here with a higher swing high. So the market structure is bearish. I'm not looking at this setup. This is why I'm telling you, I tell this all the time, okay? Is me teaching my order block theory, me teaching my fair value gap concept, is it going to become ineffective? No. Because number one, it takes a lot of discipline. You have to be absolutely organized. You have to know what you're doing. And that's why a lot of people just teach it from hindsight, because they can't really do it. So you can sound real smart, you can sound real educated and institutional, quote unquote, but if they can't do it, it's useless. So if I'm showing you these things, and I'm telling you also, look around, majority of the people that parrot what I teach, that means they're mimicking by saying what it is I already said, like an echo, but they're really not doing it. They're not doing it like I'm able to do with it. That should be your comfort. That people, by far and large, humans are lazy creatures. Okay, they're lazy. And they're not going to be predominantly rule-based, disciplined, responsible. They're going to be lazy, and they're not going to do what's supposed to be done. So it won't change anything. Okay? It won't make these things inferior. It won't change their superiority. It will not make them ineffective. They will remain constant. Now, the algorithm. I don't care how many people learn from this YouTube channel. Okay? I don't care how many people rip me off and try to rebrand and change the name of everything I've taught. All of that saturation will not change because what I just said. The algorithm is going to change. There's new suckers coming in all the time. P.T. Barnum said it really, really accurately. There's a sucker born every second. So you're never going to run out of liquidity. Somebody's born. Somebody gets old enough to start speculating and trading. Boom. They're in the marketplace. And that liquidity will just add to the liquidity that will be on the other side of your trade. So there's no reason for you to be worrying about whether or not this is going to be in effect. I've been teaching this for a long time, okay, privately. And listen, if I honestly believed in my heart of hearts that this would fail and stop working if I taught it, I would not teach it. I wouldn't. I would have never even mentioned it. And I'm being honest. So take heart. There's no reason for you to be upset about or worried or concerned. It will remain. As long as the markets are trading, these elements will be in these markets. There it is. All right, so the market rallies up. It stabs above the order block here, but it's just a wick. See that? The bulk of the volume and the bodies of the candles are inside that order block. Then the market does what? It breaks and shows displacement here. Remember what I said about this pattern here? Relative equal lows, it breaks down and it goes back to a fair value gap. Here it is again, relative equal lows, displacement, fair value gap. What does it do? Go right back up into what? The fair value gap. And look closely, the bottom of the bearish order block. See that? Bam, hits it. You watch me looking at the chart. It's there, and I'm entering on that candle. I'm not entering it because I wasn't really looking at the screen at the second when I was